Hello, my name is Joe Hoyle, and I'm one of the co-authors of Financial Accounting. And today we're looking at chapter number 4. And what I really want to do today is I want to go through the true and false questions at the end of the chapter. So my suggestion would be to stop this video and go do the 16 true false questions at the end of chapter 4, and then come back and see how I answer these questions so you can see how well you understand the material. The true false questions attempt to cover the whole chapter and to make sure you're comfortable with the understanding you have of this material. So if you've done them in advance, you should learn more. Now, assuming you've already done them, let's get started. We'll start with number 1. Here's what it says. Debits and credits must equal for every transaction. Well, clearly that's true. If you've read the chapter, you know that every journal entry, every transaction has accounts that change. And those accounts that change have a cause and effect. That's what's reflected in the journal entry. Every cause must have an effect, or every effect must have a cause, whichever way you want to say it. Therefore, they should be equal, and that answer is true. Number 2, a list of all recorded journal entries is recorded in the ledger, which is maintained by the company. That is false. And the reason that's false is that one word right there, ledger. The journal entries are recorded in the journal. The T accounts are recorded in the ledger, but this question specifically talks about journal entries. And so the journal entries are recorded in the journal. If the question had asked about the T accounts, that answer would have been correct. Number 3, revenue may not be recorded until cash is collected. That is false. Revenue is recorded when your performance obligation, whatever the company has to do, has been satisfied. The cash part is a different situation or a different part of that. What you're trying to determine is, what did the company have to do? What was its performance obligation? And once that's been satisfied, then the revenue can be recognized, even if the cash is collected at some other time. That statement is false. Number 4, a transaction is any event that has a financial impact on a company. Well, I believe that has to be true because that's exactly the definition of a transaction. Whether you buy inventory, borrow money on a note, issue capital stock to an owner, those are all things that have a financial impact on the company, and they're referred to as transactions. That is true. Number 5, the balance of an expense account. Now, this is our first question about debits and credits. And what I have said, if you've followed through in the book and in the flashcards I have produced, what I have said is that the expenses, the assets, and the dividend distribution account, those are all things that require resources. They are all increased with a debit. So if the question's about an expense, if the question's about an asset, if the question's about a dividend distribution, they increase with a debit. This question says an expense increases with a credit. It's exactly backwards. So therefore, that statement is false. We have true, false, false, true, false. That's the first 5. If you missed any of those, make sure you go back and look at them again because I want you to make sure that you understand each of those 5. Now we're going to look at true false questions 6 through 10. What we're doing here is trying to add to your knowledge to make sure that you understand how this chapter works and how financial accounting works. Number 6, examples of accrued expenses. So let's stop and talk about accrued expenses. An accrued expense is anything that grows over time. So it gets bigger over time. Does salary increase over time? Yes, because the workers earn more money. Does rent increase over time? Yes, because your obligation for that rent cost goes up over time. Does interest increase over time? Yes. If you have money outstanding or if you have a loan outstanding, the interest on that loan will increase. All three of these grow over time. Therefore, they are accrued expenses. Therefore, that statement is true. Number 7, the term revenue. Now, revenue means the amount of increase in net assets from selling a good or a service. And the term gain. Gain means that you sold something that's not a primary part of your operations. The examples I often use are if you're on a donut shop and you sell donuts, that's a revenue. If you run a donut shop and you sell the stove or the refrigerator or a table and you get more than book value, that's a gain because that's only tangentially related to the business. Those are not interchangeable terms, they are different. Now, they have a similar characteristic, but you're selling different things. That statement is false. Number 8. Posting refers to the process of analyzing transactions and producing journal entries. That is false. Posting means that you take the impact of a journal entry and you put that impact into the proper T accounts. Those T accounts are in the ledger. That process right there, where you take the journal entry and you put its impact into a T account, that's the term posting. That statement is false in that case. Number 9, a company must recognize each accrued expense as it incurs. Now, we've already said that an accrued expense is one that grows. So the question is, do you have to record that accrued expense as it grows? And the answer is that is false. In some cases, you do recognize it as it grows. Some companies do that, but other companies wait until payment is made or until financial statements are prepared. There's a lot of coverage in this chapter about accrued expenses because they're very important. Some companies record them, indeed, as they are incurred, as they grow. But other companies simply say, let's wait till the payment's made. That's simpler for us, or we'll wait till financial statements are prepared. That statement is false. The matching principle states that expenses should be recognized in the same period as revenue. That's a very old term in accounting that's been used for many, many years. When do you recognize expenses? You recognize expenses in the same period as the revenue they help to generate. That statement is true. Okay, we've now covered 10 true false questions, and I truly hope that some of these have added to your knowledge, that you're more understanding of how the accounting works. Let's look at number 11. In number 11, an unearned revenue, which is discussed in chapter 4, is reported as a liability. That is true. An unearned revenue means that a company, let's say this is the company, has received cash from a customer, but has not yet done the work. So therefore, because the cash has been received for the work, but it has not been done, then the company either owes the company that work or it owes the money back. So an unearned revenue means that you've received the money, but you have not yet done the work. That is a liability. That is true. The Hampton Company buys 20,000 pieces of inventory for $70,000. They sell 8,000 pieces, and you can see that's 40% for $5 a piece. So they're going to get $40,000. The company should debit cash, credit inventory, and credit gain. Here's how that transaction is recorded. Notice two things happen. First, you record the sale, debit cash for $40,000 because that's what they got, $5 for 8,000 units, and credit a revenue account like sales revenue for $40,000. That's the recording of the sale. The company, though, or the company then gives the inventory to the customer. 40% of the inventory was sold here. 8,000, 20,000. The inventory cost $70,000. 40% of 70,000 means that you lost $28,000 of your inventory. So you have a second entry to record that loss of merchandise. You'll take your inventory and you'll credit it for 28,000. That's the loss of inventory, and that's recorded as an expense. So you'll debit cost of goods sold for $28,000. That's how that transaction is recorded. You record the revenue and then you record the cost of goods sold. So this part is correct and this part is correct, but that part right there is wrong. You don't record a gain, you record revenue and you record cost of goods sold. That question or that statement is false. And finally, number 13, assume a company buys inventory for $8,000. It spends $700 in cash on advertising, sells 60%. This is a more complicated question. For $11,000, it collects $5,000 now and collects the remaining next year. Pay a dividend of $1,000. How much is net income? This is a very complicated question. First question is, how much is the sales revenue? And the sales revenue is $11,000. That's what they sold the inventory for. The fact that they have not yet collected it isn't important for the sales revenue. That much work has been done. That performance obligation has been satisfied. So you have the revenue. Now, what expenses do you have? You have a $700 advertising expense. Money was paid for an advertisement. That's an expense. And you have cost of goods sold. It says that 60% of the inventory was sold and it cost $8,000. 60% of 8,000 means that you have cost of goods sold of $4,800. This company has sales revenue of $11,000. It has total expenses of $5,500. The 4,800 and 4,800 and 700. If you have revenues of $11,000 and expenses of $5,500, your net income is $5,500. That's a harder question, but you can do that kind of question. And here are our last three true-false questions. I think we've done a good job of getting through the first 13. Let's see if we can get these last three. Company buys inventory for $6,000 on credit. So what happens here is that inventory went up $6,000 and accounts payable also goes up by $6,000. You know that's what happened. They bought inventory on credit. They made the entry backwards. So what they did was they recorded the inventory going down by 6,000 and they recorded the account payable going down by 6,000. So you can see that the inventory is too low by $12,000 because they recorded it going down. But you can also see that the account payable is too low by $12,000. Instead of recording it going up, they recorded it going down. Inventory is too low, accounts payable is too low. Working capital is the current assets minus current liabilities. If this number is too low by 12,000 and this number, the current liabilities are too low by 12,000, they're both wrong, but they offset. The number that you come up with, which is $140,000, these two errors, the current asset and the current liability, both being too low, offset, and the 140,000 is correct. Therefore, the amount is not 134,000. That is false. It is 140,000. Number 15. Matching is the part that comes up with the timing of expenses. It's not related to revenue, it's related to expenses. Number 15 is false. And finally, it says a company buys inventory. Notice they give you a lot of information, but here they want the gross profit. Gross profit is sales revenue minus cost of goods sold. It's not net income, it's sales revenue minus cost of goods sold. They sold the inventory for $9,000. You have a revenue of $9,000 and the cost of goods sold, they sold 30% and it had a cost of 3,000. So cost of goods sold is 3,000 times 30% or $900. How much is gross profit? Gross profit's the difference. It's 8,100. The $7,700 figure is false. 16 true false questions in chapter 4. Work on them until you can get them right, and you can do that.